Welcome to The Explainer. Okay, today we're literally bridging the gap between the beginner mechanics of the stock market and the heavily guarded mindset of a $7 billion fund manager. We are going to elevate your wealth psychology. Here's our roadmap for this explainer. First, decoding the stock market. Then, making money and paying taxes. After that, we'll hit the psychology of investing, building your portfolio strategy, and finally, real estate and leverage. Let's get right to it. Section 1. Decoding the stock market. Let's dive right into the foundational mechanics. So, what exactly is a stock? You really have to internalize this. It's not just some blinking red or green number on your screen. You're buying literal part ownership in a business. It's like owning a tiny fractional slice of apple. Now, sure, unless you have trillions of dollars sitting around, your slice is going to be incredibly tiny. But legally and functionally, you are an owner. Pretty cool, right? And because you're buying a piece of a real living business, you've got to know how that business is actually doing. Our sources map out this incredibly accessible step-by-step research process that literally anyone can do right now straight from their smartphone. You start by pulling up the 10K, that's the annual report. Next, you check the 10Q, which is just the quarterly update. And finally, listen in on their investor conference calls. You actually get to hear directly from the CEO. Now, when you open those documents, what are you actually looking for? Look, you don't need a fancy finance degree for this, but you do need to hunt down a few key metrics. You're looking for income statements and balance sheets. You absolutely want to see their profit margins, like are they actually making money on the things they sell? And of course, you'll want to check out future growth projections and valuation ratios just to make sure you aren't completely overpaying. All right, section 2, making money and paying taxes. Let's talk about how to actually put those profits right into your pocket. Basically, there are two main avenues for building wealth in the stock market. The first one you already know, buy low and sell high. If a company absolutely crushes it over, say, 10 years, the value of your ownership stake just explodes. The second way is through dividend income. This is where companies literally credit cash straight into your account just as a thank you for being an owner. But you know what the real secret is? Reinvesting those dividends. That's how you get that crazy compounding growth over time. To manage all this, think of a barbell analogy. On one side, for extreme diversification and lower risk, you've got index funds. It's kind of like lifting a nice, safe, lightweight at the gym. On the other side, picking individual stocks is your heavyweight. It carries this intense, localized risk because, well, you aren't spread out across 500 different companies. But it also carries astronomical potential if you manage to pick the next giant. Now, holding those stocks for the long haul, that acts as a massive financial advantage. Just look at the U.S. tax framework. If you sell a stock in under 365 days, short-term taxes are going to eat a huge chunk of your profits because it's taxed as regular income. But if you hold it for over a year, that long-term capital gains rate drops your tax burden significantly, down to around 15%. So yeah, patience literally pays off. Moving on to section 3, the psychology of investing. Let's pivot from the math to the mind. Let's ground all this theory in some base rates. Listen, if you only remember one single piece of math from this explainer today, make it this: 14 to 15%. If you can hit this long-term average return, your money doubles every 5 years, literally every 5 years. It is the absolute baseline that successful wealth building is built upon. But you're probably wondering, where does that number actually come from, right? It's not magic. Using India's market as a primary example from our sources, we can break down the exact math. You take a nominal GDP growth of about 6.5%, you add roughly 6% for inflation, and then toss in about 2% from those corporate dividends we talked about. Add all that up, and boom, you hit roughly 14.5%. That's your baseline. The corporate earnings of top companies generally just mirror the growth of the country itself. So if the math is really that simple, why on earth do so many people lose money? Well, welcome to the roller coaster. I really want you to feel this analogy. When you're slowly clicking up to the top of a roller coaster, or, watching a booming stock market, you feel this blind excitement. You literally think you're a genius. But then the market drops 40% in a single month, like we saw in March 2020. Suddenly, you feel irrational terror. You just want off the ride. And that extreme, gut-wrenching emotion, that's exactly what causes investors to make terrible, terrible decisions. To kind of soothe those market fears, our fund manager gives us this great compressed spring analogy. Think about it. When stock prices fall 50%, people panic. They think they need 100% gain just to break even. But remember, a stock is backed by real corporate earnings. It physically cannot fall to zero if that company is still generating a profit. So when you compress the spring by 50%, what happens? It stores energy, it recoils. Those baseline earnings ensure that the price will eventually snap back. Look, everyone knows this legendary Warren Buffett quote, but honestly, people always emphasize the wrong words. Notice the highlight here. Others. Be greedy when others are fearful, and fearful when others are greedy. The real reward comes entirely from taking a contrarian stance when the rest of the herd panics. You get the big returns by actively choosing not to follow the crowd. All right, Section 4, building your portfolio strategy. Let's talk about balancing that risk. So, the crucial point here is this massive irony in human nature. Think about it. If you're a salaried employee, your income is fixed and it's highly stable. You actually need the volatile upside of equities to grow your wealth. And yet, salaried folks are usually the ones most terrified of the stock market. On the flip side, if you're an entrepreneur, your daily life is massive risk. Theoretically, you should have your money safely tucked away in a bank. But founders, they're usually the ones taking out massive loans to expand. As humans, we are intrinsically terrible at balancing our own risk. To combat this blind spot, our $7 billion fund manager uses a highly contrarian asset allocation for his own personal wealth. 50% equity and 50% real estate. Zero fixed income bonds. None. It's essentially kryptonite to standard industry advice, which almost always pushes a safe mix of stocks, bonds, and liquid cash. But he takes a strictly risk-seeking, return-maximizing approach. It's fascinating. Which brings us to Section 5, real estate and leverage. Let's uncover the true power of property. Real estate is so unique because it is practically the only asset class where a young person can just walk into a bank and borrow a massive amount of money to multiply their returns. Think about it. You put down maybe 30 to 40% of the capital, and the bank just happily funds the remaining 60 to 70%. I mean, nobody is going to give you a massive loan to go play the stock market, but they will absolutely do it for a building. Our expert specifically targets commercial real estate. We're talking offices and shops. Why? Because it is the ultimate retirement vehicle. You use leverage to buy the property, and then you just let the commercial tenants' rent pay off your monthly bank installments, your EMI. You don't even need that rent money today. You literally just let the tenant buy the building for you over 15 years, until that debt is completely gone and you're left holding a massive, pure yield asset. But okay, what about residential real estate? Should you buy a house or just rent? Well, our manager bought his first home at 28 because it forced him to save and let him utilize that early leverage. But look, we have to be objective here. The math has totally changed. A modern 25-year-old might vastly prefer renting because it maintains job mobility and completely avoids getting locked into a massive, stressful monthly payment in today's highly inflated housing markets. It really just depends on your personal need for freedom versus security. Now, if you are going to invest in real estate or honestly any asset class, you have to understand capital cycles. The absolute best returns happen when a sector is totally ignored and starved of capital for years. Just think about real estate in 2020 during the pandemic. Nobody wanted it. When a sector is dismissed like that, the denominator shrinks. So when even a tiny, minor amount of capital finally returns to that space, the returns completely spike. It's a game changer. Okay, we've covered the mechanics, the math, and the mind. So I want to leave you with a question that's going to force you to confront your own financial psychology. Based on your career and your current income, are you intrinsically risk-averse or risk-seeking? And more importantly, does your current portfolio actually reflect what you need or just what you're comfortable with? Seriously, take a look at your investments tonight and find out. Thanks so much for joining me on this explainer today. Keep learning, and I'll catch you on the next one.